Commodities are back in the game. An outlook with Dr. Torsten Dennin from Tiberius. Torsten, commodities had a great move, the last quarter, I would say. Now it's May, but the first quarter in 2016, it was fantastic. And we want to talk about today outlook on commodities. What's up with them?
Thanks, Jochen. Commodity outlook is our daily business. So therefore, I'm glad to give you an insight in our latest thoughts here. So what we did recently is a presentation about commodity cycles in general, looking at the last 200, 250 years and breaking it up to the last 50 years to get a feeling about where are we in the commodity cycle. Is it an interesting opportunity to buy into commodities right now for our outlook for the next 2 to 3 years? And we are absolutely positive on that.
Great. And we also see this long-term cycle here, what you have breaked up. Where do you see cycle 3? Where are we now? What is the location by now?
What we did in a research paper is to analyze key economic indicators like economic growth, inflation, interest rate levels, and also incorporating the Chinese data because China is a new phenomenon for the last cycle. What you see here in the very last cycle, breaking into 4 different phases, is that these key parameters we are experiencing in the moment, low interest rate, low inflation, sluggish economic growth, is this capitulation phase you normally have in the very end of a cycle. So therefore our conclusion is from this data that in January, February this year we've seen the low of a cycle in commodities, and probably 2016 will be a turning year, looking at the next 2 to 3 years for a really positive environment for commodities and in general as an asset class.
Okay, so you mean we have a turn in the markets. What is your long-term market view now? I mean, relative to stocks, commodities have never been so cheap, right?
Looking at the absolute level of commodity prices, this is definitely one factor. Seeing commodities, crude oil in the first quarter in the lows at the $26 level, gold at 1,080 below 1,100, but also copper below $2 a pound. And then the second step is to see how this asset class is performing against bonds, no yield, and performing against equities. And looking at a 50-year spread chart, a ratio between S&P 500 equities versus S&P GSCI commodities, what you see here is that we are also on a 50-year low in comparison to equities. So therefore, commodities on an absolute level and especially on a relative level to equity markets like in S&P 500 never been that cheap in the beginning of a year. So it really doesn't matter if commodities are up 10%, for example, in the first quarter, because there's much more to come.
Much more to come, I like that. As you've said, we were quite sharp up in the first quarter, but it doesn't matter because still the cycle is just at the beginning. But if we compare it, for example, to technology, I mean, you have brought here a beautiful chart with Bloomberg World Mining Index and Alphabet, which is Google. So can you give us a bit of an idea what you want to show us and explain to us what it means?
Yeah, especially the title of the chart. It seems a little bit odd and also like a revival of old economy versus new economy, something we had 15 years ago as well. When we both remember this time doing investments and seeing a situation where everybody argued that you don't need shovels and picks anymore because there's internet. This is a new environment and you can send anything via online email. Nowadays Twitter and Facebook and Amazon things away, and you really don't need the basic resources sector. And this is exactly what investor sentiment is showing us in this chart. So this chart graphs the market capitalization here in this example of Alphabet, e.g. Google, but it's the same true for example Amazon or Facebook. So this shows us that the market cap of this single technology company is summing up the market capitalization of the MSCI World Metal Mining Index, so including more than 100 companies, even with the big caps like BHP Billiton, Rio, Vale, Freeport, and also with the gold mines.
And they have all the same market cap, those 100 companies like Google, like one company, right?
So basically this one company can buy everything that's moving a shovel or a truck on this planet. And this maybe it's not the right ratio. It's a bit strange, but well, this is the world we live in now. As a summary, what would you say? Commodities are cheap, that's for sure. In an asset allocation, or if I would to have invest money, what would you suggest? Yeah, commodities are cheap. The last years cheap for a reason, because we're in oversupply, and the last 2 years basically we also argued commodities are cheap, and we even got cheaper. So our punchline in a moment that we've seen the bottom out in the commodity markets for, in the first quarter. So basically end of January, the lows in the commodity markets. So therefore on the technical side we are voting for a little bit of correction mood during the second quarter, but we are strongly advising commodities as an asset class in physical, but also in regard to companies to start building strategic positions for the next 2, 3, up to 5 years, because it does make sense in regard to equity and commodities.
Absolutely, and also as a nice risk diversification, right?
Exactly.
Super. Torsten, thank you very much for the interview.
Pleasure.
And yeah, we look forward to your predictions here.
Pleasure.
Thank you. Ladies and gentlemen, that was Dr. Torsten Dennin, the Chief Strategist from Tiberius Asset Management out of Zug. And you heard it, commodities are back in the game, they are back on track. First quarter was very good, but we are still in the beginning of the cycle. So check it out. I'm your host, Jochen Steiger, Commodity TV in partnership with Dukascopy. Thanks for watching us, and bye-bye from Geneva.